Welcome to the Broken Pie Chart Podcast, episode 206. I'm your host, Eric Moore. This week, we're going to go over what no one is talking about. All right, well, no one really has it as their base case. Does everybody have it wrong? Like, why aren't people talking about a scenario where, well, I'll go through it in a second. The other thing I want to cover, too, is the spreads between the Fed funds rate or the 3-month Treasury and corporate bonds is getting really, really tight. What does that mean? What do we typically see when that happens? And, there's a few odds and ends in here as well. Everyone probably knows at this point, the Federal Reserve raised their federal funds rate up another quarter point. So, all right, what does everybody have as their base case? And just so we're on the same page, the Fed funds rate now is 4.5% to 4.75%, so 450 to 475. It's expected, or at least there's about an 83% probability that when they meet in March, they'll raise another quarter point. And then, of course, it would be 475 to 5. I will note that the effective Fed funds rate, and so here's a little inside baseball, I guess. Maybe it's not inside baseball, but just, there is a range. And the Federal Reserve didn't used to put a range on the Fed funds. They would just move the rate to a certain amount. So instead of saying 450 to 475, they might have said, well, we're going to raise it 425 to 450 or 450 to 475. And I won't go into all the mechanics of this. I think I've done this on a past episode. I can't remember which one it is. If I find it, I'll link to it. You can search Broken Pie Chart Podcast in Spotify or Apple or wherever you get your podcast. But they used to they didn't do a range. And I think part of the reason why they started to do a range is, well, they started paying interest on excess reserves, or IOER. And then the Fed funds futures, or the Fed funds, there's actually overnight securities, Fed funds, and you can go in the New York Fed. I'll put a link to that, and you can see what the actual Fed funds rate is. I said it's about 4.58 right now, and it had been 4.33. I don't know if it's significant that it's at the bottom of their range, but it all sort of plays in, and you probably, I'll link to this episode as well, have heard me talk about the overnight reverse repo market. That's where the banks are essentially lending money to the Fed, and the Fed gives back really short-term T-bills, and there's a rate, an overnight reverse repo rate. And, that got up to about $2 trillion. As I said, I'll link to this, and I'll explain what those are in another episode. I did that for probably, a half hour straight. But what you find is that it's sometimes there's pressure on rates, and they start to maybe wiggle or threaten to wiggle out of these bounds. I think that's one of the reasons why the Federal Reserve started to do the overnight reverse repos. Okay, so 83% chance they go 475 to 5 at the next meeting, which is in March. And then what happens after that? Well, if we go to the probabilities on the CME group, they run a FedWatch tool, and they have the probabilities. The central tendency, let's say, or the highest probability by, the May meeting is that they're going to raise to 5.25. And they have the rate, the highest probability that the rate will be 5 to 5.25. That's what the central tendency is. That's just a fancy way for saying that's the highest probability. So according to the Fed funds futures, we've got the rate going to 5.25, and staying there. And then November, there is a 33.5% probability, but that's the highest probability. So that's sort of the central tendency there, that rates will come back down by a quarter point, back down to 4.75 to 5%. Why do I go over this? Well, one is, these probabilities, when I say the highest tendency, like in November or September, there's a 34.2% probability that rates will be 5.25. There's a 33% probability they're 4.75 to 5. The reason why I'm bringing this up is that it's not like in a March meeting, 83% probability based on where the Fed funds futures are trading that rates are going up another quarter point. But here's the interesting part, and that's if you look at these, you look at the Fed funds futures, by December, the highest probability is 4.5, 4.75. And then if you go out further than that, and there's debate about whether it's even, you should even go further than that. Are they really transmitting any information? But I think the point of all this is that people think rates are going to 5.25. They're going to stay there for a couple months, and by the fall, they're going to start coming back down. What has the Fed been saying? Well, the Fed has a dot plot, and you've heard me before say the Fed is never really right on their dot plot. And what do I mean by that? Well, if you go back to 2015, 2014, they said, in 2 years, the Fed funds rate's going to be up to 3% again or something like that. I don't remember exactly what it was, but it was somewhere around there. And it never went up. They never raised it. They didn't start raising until, 18. And so, but just to give you an idea, they had the Fed funds rate ending about 4.5. They all seem to have it in that 5.25 in 2023. That's where they think it will end, or at least this is their FOMC participants' assessments of appropriate monetary policy, the dot plot. So 2023, and the blue dots, which is what I'm reading off, that's the median projection. So, all right, and then, and I will tell you too, the market does not believe them. Why does the market not believe them? Well, the market has about 450 as the rate, or at least it did at the end of December, according to what. So the market's saying, no, Fed, we don't believe you. We think the rates are going to be lower. In 2024, the market has it more like 3%. The Fed thinks it's going to be 4.25 at the end of 2024, and then the Fed sees it coming down and longer run, getting to about 275, 250-ish. So everyone, and I say everyone, but Wall Street Journal had a piece out at the end of the year, or actually the beginning of the year, and I'll try and link to this as well. And in it, they said 2/3 of economists at 23 large financial institutions that do business directly with the Federal Reserve are betting, one, and we'll get to this in a second, the recession, that the U.S. will have a recession in 2023. Two others predicting a recession in 2024. And they also expect a turndown in GDP growth, and they all seem, or I say the majority, sees them, going to 5%, and then eventually they're going to come down. And I think that's kind of the central thing. So why am I bringing this up? Bringing this up because everyone, if you watch CNBC right now, and I said this before, it's like the most obvious quote-unquote recession ever because everyone is saying we're going to have a recession. I mean, there's people who aren't. And everyone can't be right. Everyone normally isn't right. But the case right now is everyone thinks there's going to be a recession. We're going to go up to around 5%. And then the Fed is going to start lowering rates again. What if they don't lower rates? Or what if they keep them high or high-ish for a while? And if there is a recession, it's very shallow, or maybe there's no recession. And I think it's the one thing that nobody is saying right now, and that's the Fed is just, maybe they lower a little bit, back down 4.25, 4.5, maybe around 4, and they just stay there for a while. And think about it. If we don't have a really bad recession, or maybe we've already been in one, I'm starting to, you could make an argument that we may have already been in a really shallow recession. And I say that because the market sort of bottomed in early fall. We're seeing earnings. I don't know if earnings are going to bottom, but earnings on a year-over-year basis are going to be down. And the market's sort of run up ahead of earnings bottoming. And I don't know, we'll see. We'll know when it happens if the economy has or hasn't bottomed. But that's the case. I just look at this and I say, and by the way, would it be really, really, would keeping rates high cause an issue? If the economy is growing, you could make the case that the Fed can keep rates higher in historical context. They're really not that high. And you could also make the case that, people say, well, wait a second, the curve's inverted right now. But if the market, and I say the bond market believes that more growth is coming, you would think that at some point yields on, let's say, the 5 and 10 year and the longer run yields would go higher. So I just think I wanted to bring this up because no one seems to be on this. And as one of my colleagues said, just because no one's on it doesn't mean it's wrong. But what is the bond market telling us? There was a piece out by, I think this is Bank of America. Somebody passed this to me. And what they did was they showed the spread between U.S. corporate bonds, BBB rated. So you think about there's AAA, AA. There's BBB, BB, B, and then you have CCC, CC, and then you start getting into default areas. But it's this idea of, okay, when you buy a bond, you are taking on some risk. And there's what's called a spread. So when we look at yield spreads, a lot of times we'll talk about the high yield spread, and that are what is the yield on high yield bonds minus what's the yield on Treasury bonds. And they may use a consortium of maybe 5s and 10s or 3s, or it just kind of depends how they're doing it. Well, what Bank of America put out, and they said, okay, what they showed was that the spread between BBB corporate bonds, what you would earn in yield upon buying a BBB bond, and the Fed funds rate, or really the discount rate, which is a 3-month Treasury, because the 3-month Treasury is essentially the risk-free rate. And what they show is that spread right now is really, really tight or narrow, meaning what you get on a BBB bond is not that much more than what you would get in a 3-month U.S. Treasury bill or above the Fed funds rate. And the Treasury bill, 3-month Treasury or 90-day Treasury is going to be normally right around what the Fed funds is going to be at as well. So kind of took a look at this, and I went and I looked and I said, let me pull some data, and I want to get some eyes on this myself. And yeah, the corporate BBB spread to Fed funds, I did that way first. Last time I checked, the spread was about, this is at the end of January, about 2.43%, meaning Fed funds rate is, actually, I'll tell you what the Fed funds rate is. So the Fed funds, or the effective Fed funds rate at the end of, let's see, the very end of, yes, 4.33 at the end of January. And BBB bonds, the yield was 6.76. So the difference there is 2.43%, or 243 basis points, if you want to use kind of the industry term. And I looked and I said, well, it's been trending lower. For example, if you look and you say in July of 21, the spread was 6.77%, or 677 basis points. So that spread has collapsed. And to give you some context, the spread in January, 2.43%, we'd have to go back to around November of 2007, the last time it was that tight of a spread. Just for argument's sake, it's not as low as the yield spread was, triple Bs to Fed funds, let's say in April of 2007. Then it actually got down to about 178 basis points, 1.78%. And then what other times was it really low? Okay, well, we go back and we say, let's look at, here we go. This is July of 2000. It was 106 basis points, so 1.06%. So why do I bring this up? Well, if you were to say, hey, this spread is a little bit compacted right now, there's two things that might happen. You might say, and I don't know what will happen. This is why we buy and we hedge. And if you want to learn more about that, derek.moore at zegafinancial.com, derek.moore at Z as in zebra, E as in Eddie, G as in George, A as in Apple. Financial is up to you to spell correctly.com. Or just show ideas, topics you want covered. I did have a few questions on yield spreads recently, but to be honest with you, I saw and someone passed me the B of A piece, and I was sort of gotten interested in that. So, okay. So what are the two things you might deduce from this? You might say, okay, well, nothing might happen. The spread could stay here. You might say, okay, well, maybe as the effective Fed funds rate comes up, maybe the spread triple Bs to Fed funds narrows even more, meaning the amount of interest that you would get on a triple B versus a 3-month Treasury. Remember, if you buy a 3-month Treasury, that's essentially the risk-free rate. You don't have any interest rate risk. I mean, it's only 90 days. So if interest rates go up 10 times from here, in 90 days you're getting your money back at par, and then you can go find a new bond at the 10 times higher rate. So nothing could happen. We could see spreads narrow a little bit more. You could also see spreads widen, and that would be where bonds are selling off, and bonds lower, market values go lower, yields go higher, the yield to maturity. And the yield to maturity is a combination between what you buy a bond at and what it matures at par, and you assume it matures at par. Some bonds can get called. Of course, there's always default risk in corporate bonds. But, the yield to maturity is a combination of the coupon, the interest it pays, and what you wind up, the difference between what you buy it at and what it matures at. Okay. So you could see those widen. And by widening, again, it means bonds are selling off. Because you might say, okay, well, given the choice, would I want to buy a risk-free asset or buy a corporate bond that has more risk than a U.S. Treasury? The other thing that could happen, though, is maybe corporate bonds stay where they are, and what winds up happening is maybe the Fed funds rate, maybe this is the market's way of saying, we don't believe you, Fed. We think that this is going to have to come down, and that's how spreads will, quote unquote, re-widen or get back to, less extreme levels. As I always say, we'll let you know when it happens, but this is something to keep an eye out. It is note that the high yield spread has tightened a little bit. I don't think it's at extreme levels by any means, but that just means the spread of what you're getting in high yield bonds and what you're getting in treasuries is more narrow. And so this is something to keep an eye out. The other thing I'll mention as well is, and I'll also put a link to, you can pull all this up yourself if you just Google Fred, F-R-E-D, triple B, so BBB spread, and you can find the spread. You can also put pull up the effective Fed funds rate. You could also find the 3-month Treasury, the market yield, meaning if you're going out into the market and you're buying it, if you're buying bonds that are already out there, not new issue, what's the yield to maturity? So I'll put a link to all those in the show notes as well. So some of you are saying, okay, you've talked about the bond market. What does that mean for equities? Well, if bond spreads widen, you would expect equities to come under some pressure. They may not, but Again, I don't know what's going to happen in the market. That's what we buy, we hedge. That's a central thing of what we do. But I'm reminded of this week, Professor Aswath Damodaran, NYU. And if you haven't checked out his site, I'll put a link to it. He's got a lot of historical data that's on there, and he puts out some interesting content. He has sort of these four different ranges of outcomes. So I guess you call this a 2x2, right? So he has no recession, steep recession, then he has inflation subsides to pre-pandemic levels, inflation stays high. Okay. So if we look at that, and I will note that, the CPI is still above 6% year over year. And I'll say this again, it's always really interesting when we come out with GDP. GDP comes out in a quarterly number that is then annualized. It's not, it's quarter over quarter, but then it's annualized. So, and then they say, okay, so if, the last one was at 2.9%. So it's not exact math, but you sort of take that divided by 4, and that's what the quarter over quarter, but then you assume the growth on an annualized basis, and that's real, meaning after inflation. And then you have the way inflation's reported, and CPI comes out, and they'll have a monthly change, and then the sort of the headline CPI number is a year over year number. So, for example, when it was got up to 8%, or right now I think it's a little above 6%. The one for December, which is reported in January, that looks at December of 2021 to December of 2022, and they say that's the year over year. What's interesting, though, is that if you take, let's say, the last 3 months, 4 months, 5 months of inflation, and I mean, it's really not budging. It's gotten where it's gone, but it's not really budging. And of course, the problem with inflation is it never really goes down. Those price changes or those increases in price are embedded in the economy. And when people say inflation's going down, they don't mean that all those prices are going down. They're just meaning the rate of change going forward is lower. And I think Chairman Powell called that disinflation. So you have inflation, which is prices going up a lot. I'll just use like real, kind of the slang term. You have deflation, which is prices going down. Typically, we don't really have deflation unless, bad recessions, and then it doesn't last. And then you have, let's say, normal inflation, which the Fed will tell you is 2-ish%. And then you have disinflation. Disinflation means that the rate of change or the amount that inflation is going up at a less hot pace. How's that? So back to Aswath Damodaran. And he does a lot of valuation, and he says, okay, so the first case is inflation subsides to pre-pandemic levels. And he says, what would have to happen for no recession? Okay, and there's no recession line. He says the T-bond rate, which is the T-bond meaning, I'm sure he's talking about the 10-year yield on the 10-year Treasury, drops to 2%. Earnings come in at analyst estimates. He doesn't say whether analyst estimates stay firm where they are. And he has, an index value somewhere around 4,300. Okay. And then there's also the no recession camp where the T-bond rate rises to 5% and earnings come in at analyst estimates, but inflation stays high. Now, I would also say, and then he has, the index value, again, he does valuation, is around, 3750, 3760, something like that. Now, he has this in the inflation stays high camp. And maybe he's right that the T-bond rate, the 10-year Treasury, can't go to 5%. I mean, right now it's hovering around 3.5%, unless inflation stays high. I would also say that I think inflation could come down, and if the Fed, in that scenario that really no one is talking about, where they keep rates high, I mean, they don't lower rates back to 2% or below 2%, then why wouldn't the curve reinvert and the Treasury, the 10-year Treasury would go higher? But anyway, I regress there. And then he says, okay, what if we have a steep recession, but inflation goes back to pre-pandemic levels. All right, and here he has the T-bond, the 10-year Treasury going to 2%. Earnings in 23 and 24 come in 20% and 10% respectively below analyst expectations. He says, okay, well, the market's got to go to 35.80. And then inflation stays high, so the T-bond goes to 5%, earnings come in 20%, 10%. The index value should be, 3,200 or something like that. I know from following his stuff, he doesn't make predictions. He says, he always says, look, I just look at the numbers, I run it through the scenarios, and these scenarios can change. So I think also in here, and maybe he's written about it elsewhere, but I still say there's that we've already had a slight recession, we don't have a recession, or we still have yet to have a very slight recession. Inflation doesn't necessarily rise again. But I think the one everyone's not talking about is maybe rates stay higher. And the 10-year, the 5-year, the longer-term bonds, that curve, the back of the curve, which is inverted right now, meaning short-term rates are higher than long-term rates, that sort of works itself out, and Treasury bonds go back up to 5%, and earnings are still pretty good. So look, I don't know. I don't know what's going to happen. We make predictions just sort of in a fun way, as we're all students and the market and things like that. But I just don't think anyone is talking about those scenarios. I would keep, if you want to keep an eye on the high yield spreads, I'll put a link to all that stuff in the show notes. It's Fred, F-R-E-D, and you can put high yield spread. You can put triple B spread, double B spread, all those types of things. And you can see that. And you can also pull up the 3-month Treasury. So that's one of the things that Bank of America is talking about. All right, so look, we're going to leave it there for this week. Appreciate everybody tuning in again. Continue to send me emails, derek.moore@zegafinancial.com. Love to hear from the listeners and ideas on future topics and shows. And next week, we'll have one of my permanent co-hosts on again. And we'll talk to y'all real soon. Take care.